Welcome to CoreLogic RP Data's update on housing market conditions for July 2015, brought to you by Smartline Personal Mortgage Advisors. This month we bring you a summary of the housing market over the financial year, where capital city dwelling values increased by 9.8% over the year. Based on the current median dwelling price of $565,000, the 9.8% increase means the typical capital city home has increased in value by about $50,000 over the year. At 9.8%, the rate of growth across the 2014-15 financial year was virtually on par with the previous year when dwelling values were 10.1% higher. While the rate of capital gain has remained high over the year, we don't have to look back very far to see when the housing market conditions were actually stronger. The 2009-10 financial year saw dwelling values rise by 12.3%, and over the 2001-2 financial year, capital city dwelling values actually climbed 20.7% higher, highlighting that growth rates have been much higher previously. Conversely, it was only 4 years ago when we saw 2 consecutive financial years when dwelling values fell across the combined capital cities index, providing a timely reminder that property values don't always rise. Across the capital cities, the rate of dwelling value appreciation has been a story of diversity. While home values in Sydney and Melbourne have streaked ahead, rising by 16.2% and 10.2% respectively, we've seen market values fall in Darwin and Perth. While the remaining capital cities have all seen dwelling values rise by 4.5% or less over the financial year. If we look at the capital gains in approximate dollar terms over the year, Sydney dwelling values have moved nearly $108,000 higher over the year, and Melbourne values are up $52,000. The annual falls in Perth and Darwin have taken the dollar value of local dwellings approximately $4,400 and $15,500 lower over the financial year. The divergence between the performance of houses and units also widened over the financial year, with capital city house values increasing by 10.4% compared with a 5.6% rise in unit values. This trend, where houses have outperformed units for capital gains, has been very evident across each of the capital cities except for Hobart and Darwin, but it's most exemplified in Melbourne, where house values were 11.2% higher over the financial year compared with a 2.4% rise in unit values. It's likely that the additional level of new apartment supply is keeping a lid on the pace of capital gains across this sector of the market. While dwelling values recorded a high rate of capital gain over the year, at least in Sydney and Melbourne, rental rates have continued to move higher at a much slower pace. Overall, rental growth across the combined capital cities was recorded at 1.1%, which is the slowest pace of rental growth on record. Rents are rising the fastest in Sydney and Hobart at 2.6% and 2.8% respectively, while rents are falling in Darwin, Perth and Canberra. With dwelling values rising at a faster pace than weekly rents in every capital city except for Hobart, it's clear that the ratio of rents to home values is looking increasingly low. Gross rental yields across the combined capitals are approaching historic lows, with a typical house showing a 3.5% gross yield and units showing an average gross yield of 4.4%. Rental yields are the lowest in the cities where home values have grown the most. In Sydney and in Melbourne, the gross rental yield in Melbourne reached its lowest level on record in June, with a typical dwelling providing a gross yield of 3.3%. Sydney is close behind, recording the second lowest gross rental yields of any capital city at 3.4%, which is only a short distance away from a historic low. Now let's have a look at the capital city housing markets across each capital city. Cities remain the standout for capital gains across Australia's state and territory capitals, with dwelling values increasing by 16.2% over the financial year. The rate of dwelling value appreciation has accelerated over the second half of the financial year, spurred on by the lowering of interest rates in February and May. The strong New South Wales economy, as well as high rates of migration and significant investor demand, are some of the primary drivers of growth in this market. Auction clearance rates have shown a subtle softening during the winter months across Sydney. However, week-to-week clearances remain well above 80%, indicating vendors continue to enjoy strong selling conditions in this very hot market. Melbourne's housing market's been playing second fiddle to Sydney's over the financial year, with home values rising by 10.2% compared with Sydney's 16.2% gain. Melbourne's housing market accelerated over the second half of the financial year, with dwelling values rising 5.5% over the 6 months to June 2015, most likely in response to lower mortgage rates. The gap between the performances of houses versus apartments was the widest of any capital city in Melbourne, with house values up 11.2% over the year, compared with a relatively sluggish 2.4% capital gain across the unit market. The heightened supply of Melbourne apartments is likely to be one factor that's kept the rate of capital gain lower across this sector of the market. Brisbane's housing market recorded the fourth highest rate of growth across the capital cities, with dwelling values up 3.4% over the year. Most of the gains were confined to the detached housing sector, where values are up 3.7% over the financial year, while unit values dragged the average lower with a growth rate of just 0.7%. Higher levels of new unit supply may be weighing down the capital gain performance within this unit sector. With Brisbane's underperformance relative to Sydney and Melbourne, housing affordability is much less of a challenge. Brisbane's median house price was recorded at $487,500 at the end of the financial year, which is about $412,000 lower than Sydney's and $127,000 lower than Melbourne's. The Adelaide housing market has seen a 4.5% rise in dwelling values over the financial year. While this is the third highest rate of growth across the capital cities, the gain in values is much lower, and for that matter, much more sustainable than the growth in Sydney and Melbourne. Adelaide house values are 4.7% higher over the year, compared with a 2.0% rise in unit values. Gross rental yields are slightly higher than the capital city average across Adelaide, with houses returning a typical gross yield of 4.1% and units providing a gross return of 4.9%. Affordability is much less of an issue across the Adelaide marketplace, with a median house price of $430,000 at the end of the financial year. Perth's housing market has softened in line with economic conditions across the state and a sharp slowdown in migration rates from both overseas and interstate. Local dwelling values moved 0.9% lower over the financial year. Both house and unit values were lower over the year. However, it was the unit market that has recorded the most significant fall, down 4%. While values have started to retrace after a solid period of growth, weekly rents are also backtracking, down 5.2% over the year. Prospective buyers are now very much empowered across the Perth market, with a 15% uplift in the number of properties being advertised for sale, as well as a higher rate of discounting from vendors in order to make a sale and longer average selling times. Hobart's housing market, despite recording only a 0.9% growth in dwelling values over the year, has seen market conditions accelerate over the second half of the financial year. Between July and December 2014, Hobart values actually fell by 0.7%, while values moved 1.7% higher over the first 6 months of 2015. Hobart's also the only capital city to record an improvement in gross rental yields over the year, due to the fact that weekly rents are increasing at a faster pace than dwelling values. Hobart's now showing the second highest gross rental yields for houses and third highest rental yields for apartments across the capital cities. After very strong housing market conditions over most of the past decade, Darwin's housing market has started to slow sharply, with dwelling values down 3% over the financial year. Rental markets are also weakening, with local rents down 8.1% over the past year. The fact that rents have fallen by a larger amount than dwelling values has pulled rental yields down as well, with a typical Darwin house now providing a gross yield of 5.8% and a 5.3% gross yield on units. The dust appears to be settling around the Canberra market after a relatively soft housing market performance over the past few years. Dwelling values were 2.4% higher over the financial year, after showing an acceleration in the rate of growth over the second half of the financial year. An increase in house values was the driver of the annual capital gain across Canberra, with house values up 3% over the year, compared with a 4.7% fall in unit values. It's no coincidence that the best housing markets are located in those cities where economic conditions are the strongest and migration rates haven't slowed down. Regions tied to the mining sector, particularly Perth and Darwin, have felt the brunt of a softer economic performance and lower migration rates, which implies lower confidence to make high commitment decisions and less demand for housing as fewer residents arrive in the region and more leave. With Sydney and Melbourne dwelling values now 43.1% and 25.9% higher over the current growth cycle, which commenced at the end of May 2012, it's reasonable to expect that an increasing number of prospective buyers will be blocked from buying a home in these cities due to affordability constraints. Additionally, very low rental yields in our two largest capital cities implies more than just poor rental returns for investors. Low yields are a signal that housing values are high compared with rents, and it's likely more households will consider renting over buying for affordability factors. Another factor that may conspire to take some heat out of the Sydney and Melbourne housing markets is tighter lending conditions from the banks. The pace of credit growth for investment loans remains outside of the APRA guidelines, which were issued in December last year. Overall credit growth for investment loans is tracking at 10.4% per annum, while APRA would like to see that at 10% or less. We're already seeing the banks announcing changes to the lending policies that should see investment lending slow down over the new financial year. Looking forward to the next financial year, based on the factors just outlined, we would be surprised if growth in Sydney and Melbourne dwelling values didn't start to moderate over the year. With household debt levels moving to new record highs over the March quarter, Australians are more sensitive to the cost of debt, and arguably the housing market is becoming more susceptible to a downturn if there is a trigger event, such as a sharp rise in unemployment, interest rates, or an external shock. None of those events appear to be on the cards currently that will trigger a significant fall in dwelling values. Thanks once again for tuning into our housing market update. For those of you that haven't heard, you can now access detailed housing market information at our new website for buyers and sellers, propertyvalue.com.au.